The following is for information purposes only and should not be considered investment advice. All opinions and views expressed by the contributors to this podcast are in a personal capacity only. They do not represent the views of Progressive Equity Research or any other organisation mentioned in this podcast.
Hey, Jeremy.
Morning.
So it's Thursday 13th. It's felt like an interesting week. I think there's still steadily improving signals from a number of different places. We had the European Parliament elections earlier in the week, which was sort of big in terms of macro news. What did you think of that? And what else was going on?
So, politics certainly dominated the early part of the week, following the weekend's European parliamentary elections, which was not a great surprise in terms of the shift to the right and the growth of populism and nationalism throughout the EU. But I think the big surprise was the triggering of a national election in France.
Yes.
And the impact that had on financial markets was quite significant. So the euro weakened on the back of that, and the yield on French government bonds moved out to a larger than usual premium to German bunds, suggesting investor concern over the potential for a protracted period of European political uncertainty.
Okay.
Because I think Macron not only caught his own electorate off guard here, but also financial markets.
Yeah, it was quite a shock to everyone. But,
the French are going to be going to the polls before we do, so they don't mess about. I mean, obviously, it doesn't affect him. He's president until 2027, but his National Assembly, which he hasn't had control of for a while, he's basically bringing this to a head and asking his electorate to back him so he can do things going forward. But in the eventuality that the right consolidate their lead in the National Assembly, then I think that will beg all manner of questions of political uncertainty, not just for France, but for the wider European Union.
And do you think that market reaction, was that because the markets were worried about France moving to the right, or was it more of a worry that you might have Macron unable to do anything if he's got a right-wing National Assembly and he won't get anything through Parliament?
I think it's just the uncertainty of not knowing, and therefore not knowing what the relationship between any future French government will be with the ECB and particularly Germany.
Yeah, there's a lot to play out there, isn't there? Yeah. Okay.
So as that was going on, we also had earlier in the week, currency markets were going through another little volatility spike in Asia, particularly with a focus on the US dollar yen rate, which was the main centre of concern. We've got a Bank of Japan rate decision tomorrow, and we get the Japanese inflation data next week. So that kind of reminded us that we are entering a period of increased uncertainty and volatility in bond and currency markets, and that has wider implications for financial markets.
Right.
But amidst all this, while the UK media and maybe we as individuals are getting probably a bit bored of the UK political scene, as far as financial markets concerned, the UK, I think, continues to be a backwater by comparison to things that are going on in the rest of the world, like Mexico and our friends in the EU.
But backwater in a good way, in as much as lower risk and safe place to put money.
I think we all know who's going to win the election. The complexion of the next parliament has been made more uncertain by the arrival of Mr. Farage with reform. But, the actual outcome is known and the policies are well rehearsed. An incoming Labour government is going to be constrained, at least initially, by the same spending limits that the current lot are constrained by. So financial markets are not concerned. And the UK market is still showing positive momentum and relative outperformance compared with most other markets. That goes for our currency and for our equity market for sure.
Got it.
But the big economic news this week was over the Atlantic, where we had the 1-2 punch of US inflation data and the Fed rate decision both out yesterday. The inflation print was a notch lower than the prior month at 3.3%. And the Fed surprised nobody in keeping rates on hold for another month. So it is higher for longer. Although the forward guidance was for fewer rate cuts this year than previously expected, they were more explicit about the intention to cut rates at some point, and maybe twice, but probably just the once. And therefore, the market impact of this was relatively subdued. I mean, the dollar firmed up because there is an interest rate differential now building up between the dollar and the euro, and probably the pound in the not too distant future. So there's been a bit of a risk-off chill in the markets this week globally, but nothing significant. Meanwhile, back in the UK, we had average earnings figures and unemployment data. Average earnings is running at 5.9%, remains significantly higher than our inflation rate. I mean, just to remind you, our inflation rate is at 2.3%. I mean, much closer to the 2% benchmark than the US came up with this week. But, average earnings are now running at a significant premium to our level of inflation. This is a positive difference that we haven't seen since before the global financial crisis.
Right.
So well over a decade. So this is good news for the UK consumer, good news for those people who do have jobs, but one suspects it's not that sustainable, but we'll have to wait and see.
Okay.
And we had the news this week as well from the UK on UK GDP. Economic growth had a month off in the UK in April, largely explained, I think, by the appalling weather we've been having.
Yeah.
But not a huge concern. So unemployment edged up a bit. Obviously, average earnings up. I think the UK economically is in an okay place, given that expectations have been so poor for such a long time. So overall, we carry on. The world is slightly more uncertain, slightly more volatile, slightly more chaotic. But my thesis still remains that the UK is a relative safe haven for global investors.
Well, you've been right for a while, and clearly this week has demonstrated that in a few more ways. And I'm sure there'll be more ways that it's demonstrated over the coming months. But
we'll see. Yeah.
But yeah, we'll take it while it lasts. What else are we seeing in terms of the UK corporate market this week?
Well, I think the big event in UK, certainly small and mid-cap land, was we've got a decent IPO. And the IPO of Raspberry Pi got away, £540 million deal. Indications I've heard that the offer was essentially 10 times oversubscribed, with reasonable size investors left with no allocation. As we talked about before, the sponsors left little chance to doubt here. They got a very well subscribed cornerstone round in before they offered it more widely to the market. Although it's probably a disappointing outcome for some smaller investors, it's a very good outcome for UK capital markets.
Yeah,
I think it sits nicely in that category of company that the UK market has been pretty successful in developing over the decades.
Yes, absolutely. I think the UK has got a reputation for developing some really great niche technologies. A number of people have made the point over the years that we're never going to be able to compete with the US or certainly China evolving or bits of the European markets in large scale, very broadly applicable technologies. But what we can do very well is smaller niche businesses with particular skills and expertise. And we do that well. And Raspberry Pi is a great example of that sort of thing with legacies of great heritage. And yes, it was crucial that the deal was successful and seemed to be successful. And it looks like it's been executed excellently with a decent premium, not an embarrassingly high premium. So it doesn't ludicrously underpriced.
I think if it was up 50 or more percent or, then I think questions would be asked. But 30%, 35% or whatever it's trading at is acceptable.
Yeah. No, so it's a big relief to get that done and hopefully opens the doors to more in the coming months. So,
In terms of other news in the UK, two other sort of bellwether updates. One was a warning from sofa retailer DFS. I always think it's quite interesting when DFS has a bit of a tougher time because you can say it's reporting on a soft upholstery market.
Okay.
Pun intended.
Very good.
But demand in the sector, they said, has remained challenging. And one of the things they highlighted was this issue that's lurking around in the background in a number of sector, which is what they referred to as Red Sea routing issues that have persisted, resulting in customer delivery delays. So not only is customer demand for sofas lower, the orders that they do have are not being able to be delivered on time because of issues of shipping this stuff from the Far East.
Okay. So a resolution of the Israel-Gaza conflict would be very good news.
And other issues. The Middle East issues generally.
Sure.
Everything's being rerouted, taking longer and costing more. Yeah, and the other bellwether update for those of us in the market is Peel Hunt, one of the larger UK domestic brokers, reported today, and in their outlook statement, they're seeing an increase in activity in their execution services and institutional trading businesses. Public M&A is highly active across the market. There's bid activity for undervalued UK assets continues. And then they said against this backdrop, equity capital markets activity is beginning to build from low levels of the last 2 years. And whilst the IPO market has not yet fully reopened, UK investors are increasingly receptive to high quality companies. Now, Peel Hunt, I think it was just 2 brokers that were involved in the Raspberry Pi IPO. So they're in the vanguard, if you like. But despite all that, and despite growing their top line, they still lost money in the period. Now, that kind of tells you how tough things are out there in UK small cap, mid cap land.
Yeah, but signs of improvement. And
definitely signs of improvement.
Yeah. We also saw a similar theme from a much smaller business, progressive client, Oberon Investments.
Yeah.
And they had a trading update actually out this morning. And they've got a wealth management business that they've been growing steadily. They've also got a capital markets division. And a bit like the Peel Hunt commentary, that they were certainly saying that, yes, it's seen tough trading across much of the last year, but they certainly saw an improvement in the first calendar quarter of 2024. So definitely signs of improving markets, and hopefully there'll be more of those coming through.
As I think we've both noticed, there's been a steady stream of smaller deals going through.
Yeah, absolutely. Yeah, lots of smaller companies raising relatively small amounts, but increasingly frequently and seemingly with good success. So hopefully that will continue. Other news from progressive clients, we've had half-year updates from both Oxford Metrics and Idox, in fact, half-year results from both of them, both looking pretty good. Oxford Metrics talking in particular about having 90% visibility over their full-year numbers, which is pretty good for this stage of the year. But most investors, I think, will be looking very much to see what they're going to do with their cash pile of give or take £50 million in terms of the way they might deploy that. And Idox showing some pretty good revenue growth, in particular with recurring revenue, which is key to valuation of some of these businesses. Recurring revenue is up 29% year on year. So some nice growth from both of those, and solid H1 results from the pair of those. How are things looking for next week?
We get UK inflation data on Wednesday, and I think look out for headlines. I think this could be the first print we get below the magical 2% target level since July 2021. So nearly 3 years ago, we last had inflation running at below the target rate of 2%. And I think it looks like we might get reported on it as early as Wednesday next week. So let's see. Okay. We also on Thursday get the UK rate decision from the Bank of England. The pending general election makes it almost unthinkable that there will be any changes made. But obviously, as usual, be interesting to see how the mood music is in what Mr. Bailey has to say.
There's no rule that stops them bringing rates down.
I don't think so, but I think their desire to remain aloof and detached from politics would mean they'll just stay out of the way.
Okay.
I think most expectation now is that we'll get a cut probably at the August meeting. I think that's very early August. And so that would be a nice present for the incoming Labour government, no doubt.
Yeah.
That we'll see.
Yeah. Okay. Brilliant. Thank you for that. All good. And we'll catch up this time next week.
Yeah. Okay. Look forward to it.
Okay. Talk to you then.
Bye.
Thanks. Bye.
Brought to you by Progressive Equity.